Morning, everyone. There's nothing like kind of filling in late in the game last night and coming here and going last and having 2 minutes to give a 15-minute presentation. I feel a little bit like the NFL referees out there today, but I promise I won't run out like they do after the end of the game. I'm going to stick around and answer questions. Real briefly, who is Cadence Bank? And I'm going to try to catch us up on a little bit of time here so we do get some Q&A. A year and a half ago, we were 13 employees and $1 billion in our pocket. Today, we are 3 banks under our belt, $5.5 billion in assets, and a full-service bank and 1,500 employees through the Southeast. We've had a lot of fun. It's been busy over the last 18 months, but we're excited, and most notably in Houston, we just closed the acquisition of Encore Bank. It's a great organization, and we're looking forward. If you see an Encore Bank this weekend, you're going to see the signs change to Cadence Bank. And so we're off and running here. So full service bank, and we're looking forward to building our organization throughout the Southeast. One thing, before I get too deep into my presentation that I want to talk to John about was that non-recourse financing that he was discussing on his slides. I think he meant to have that up on the top with the insurance folks, not the banks. And so please don't come to me and ask for non-recourse. We can talk limitations on that, but I'm not in the non-recourse business right now. So where is banking today? The bottom line is we're operating in a heightened regulatory environment. The comments that you're seeing now is the government's out to child-proof the industry. When I tried to child-proof my house, when my kids came along, it was pretty difficult to do, and I just don't think they're going to have as much luck with it either. Dodd-Frank, which is currently 7,224 pages, I think Obamacare is the only thing that rivals it with as far as if you stacked it end to end, I think it'd be a little higher than us, but currently we're exceeding the Empire State Building in height and paper, just a little point there. In Dodd-Frank, there are 400 new regulations. There are about 125 into it. So not only do we have a lot of regulation now, but there's more to come. With that, you're going to have a situation where many of the smaller institutions, and when I start talking about smaller institutions, I mean banks $1 billion in assets and less. The median-sized bank today has only 37 employees. When you have regulation, that turns into cost and expenses. And so the question then becomes, does that expense get passed on to the borrower? And I think there's a real possibility that could occur. Basel III is another topic that we're seeing on a regular basis. It's going to change some of the capital requirements. I'm going to talk a little bit about it here on the next slide. And so what is exactly going to go on with Basel III? Basically, the bank capital, what we can count as our capital, is narrowing, and the risk-weighted assets are increasing. And for example, under the mortgage, the amount of capital you have to hold against a mortgage is doubling under the new Basel III requirements. So if you take the regulation coming from Dodd-Frank and you take the Basel III changes that affect those banks $500 million in assets and above, there's a lot of regulatory coming down. And as I said, it's going to be very expensive for banks. And I will also tell you that it'll push the M&A activity, I believe, because many of those organizations that are now currently in a 7 years into a 5-year plan, it's going to have to push it to a point to where M&A activity will increase. It'll become more expensive. It could potentially become more expensive to borrow. And in addition to that, as a bank, we're going to have to narrow the industries that we can lend to with as much regulation and the new requirements under the Basel rules and the changes in regulatory. Accessing capital is going to be more stringent in the credit environment. I think, as has been stated a number of different times, there's a massive deleveraging that has occurred over the last couple of years. The interest rate environment has decreased, and so many of the companies that are borrowing are going out and trying to reduce their costs, their borrowing costs. This is occurring. So what we've got here is a margin that's getting smaller and more regulatory environment, as I've kind of said a couple of times. One thing, the bottom point here, the chicken and the egg dilemma to me is I get accused of only lending people money when they don't need it. At some point, you really have to get out and take on some risk and really understand someone's business. And it's important for us as banks to get healthier and get out and support the growth that we have in our communities. And I think that is going to change here as we go forward. So where are banks today? We're improving in asset quality. I'm going to give a few numbers here. Just on the top right there, when you see non-accrual loans, which is the blue line there, and then the red line is quarterly net charge-offs. The trends are good. The trends are good. And we're not back to historic levels, but certainly we're in a better place. Loan loss provisions are down. They're at a 5-year low, down almost 26% from last year. Charge-offs are down 30% from last year, and you're seeing a good work being done in the loan as non-current loan balances, and we define that as 90 days or more in past dues are on non-accrual status. So it's improving. I will tell you, it is very expensive to work the non-accrual loans, the problem loans, and so that many of the banks are telling you that there's expense management. It's 100% accurate. We've spent a lot of money trying to collect some of the problems we've had. We are getting better at it today, and it's improving, but still have a little ways to go as we're not at historical levels. FDIC insured institutions from a height of 15,000 last year, just over 7,300, it's down. In the chart on the right there, I will show you two different things. Quarterly failures. It's a good thing that we're not seeing banks fail every Friday afternoon. It is, certainly, just hard to handle, and it's not good for the industry there. So we have seen that decline. In addition to that, you have the net quarterly change in number of problem loans banks, and so as you can see, it has continued to decline too. So the environment in general is improving nicely. The U.S. financial institution mergers and acquisitions, as I said earlier, I think that you're going to continue to see a lot of activity here. Both in 2012 and in 2005, you have an interesting data point there, where in 2012, 82% of the deals for bank assets less than $500,000, and in 2005, since 2005, you have 84% in that category. If you're a $480 million bank and you see a lot of regulatory environment change and you see Basel III coming, you're for sale at this point, in my opinion. And I think this will continue. The valuations that you get on the smaller end of the spectrum are less than what you're seeing on the larger end, and I think that trend will continue. Some would suggest that with the Encore acquisition that we push that number pretty high and help these ratios on the higher end. I'll debate that with you as if you want to sit around and talk after it. The institution is such a great organization, so we think we paid just the right amount for that. As far as Texas, we should be glad that we're here. The financial institutions here are performing quite well when compared to peers. As you can see here, across the board, the institutions are doing better in Texas. We should be glad that we're here with the job creation. I think it's very important. Once again, the smaller banks are trading and at a little bit lower level than some of the larger banks that you see, a common theme throughout. In the next page, on the earnings, I will tell you that on every conference call, what you're hearing is that loan demand is not quite as high as they would like, and that there are expense management measures being taken across the board. I would tell you in Texas, the loan demand is pretty good, in my opinion. As John mentioned, we've got a lot of real estate deals that are going on, and we're a little more conservative now than we were just 5 years ago in how we're underwriting that, and so I feel good about that. The larger companies have not gone out and said, hey, I'm ready for the big boom. They're waiting on many of the things, whether it's election and some resolution in Greece and other countries. They're sitting on the sidelines. And so as we mentioned before, there's a lot of cash on the balance sheet, which is a great time for banks to come in and fill in. And so many of the folks who are looking for financing through M&A activity are well capitalized and really low multiples on the earnings side. So this is one of my favorite quotes from Forbes, talking about America's coolest city, and I'll take you just to the first bullet point and what its conclusion is, and we've said it before, it's jobs. We're creating jobs in Houston, and we're creating jobs in Texas. This is important to us. It's important for the market, and we like to see the investors come in. The one thing is, and I wear my tie that has an oil derrick on it just about every day here because we are energy related. And we need to embrace it, and I will fill my SUV up with $80 of gas twice a week, all day long. And I think the other point you might come to, it says the #1 spot on Forbes' list of America's coolest cities to live is Houston, weather not included in that comment. So we're in a great place. I'd like to thank the folks, Chris and Bill, for having me this morning, and happy to answer any questions that come up.